Welcome to today's deep dive. We're going to be looking at this Vanguard report,
Mm.
their economic and market outlook,
Yeah,
and focusing on 2025 and beyond.
it's a big one.
Yeah, it's packed with all sorts of insights on global trends, inflation, interest rates,
Yeah.
you know,
Whole shebang.
predictions for how different assets might perform,
Yeah.
the whole thing.
Trying to look ahead,
Yeah,
into the future and map out
right.
the forces that are going to be shaping things. So
Yeah,
it should be useful for us.
it should be useful. And, our mission today is to kind of equip you with the knowledge to make smarter financial decisions in the years ahead.
Absolutely.
Yeah. Okay. So the report, it kicks off by painting this picture of a global easing cycle hitting full swing in 2025.
Okay.
They're basically saying that, most developed economies, they're going to see inflation drop close to that 2% target,
Right.
giving central banks room to kind of ease up on interest rate hikes. So
Yeah.
does that mean we can all breathe a sigh of relief about those mortgage payments?
Well, I wouldn't get too excited just yet.
Okay.
The
Still ways to go.
Yeah, I mean, the report does highlight, an uneven path to this disinflation they're talking about. And
Well,
the U.S. is actually expected to be a standout performer in bringing inflation down,
interesting.
which could create some, interesting dynamics globally.
That is interesting, especially since they also say that even though rates are expected to decline, they'll likely settle at a higher level than what we saw in the 2010s.
Right.
They call this the era of sound money.
Yeah.
So what exactly does that mean for someone like me who, I'm not an economist? Break that down for me.
Yeah, so think about it this way. Like, for the past decade or so, we've been living in a world of ultra-low interest rates.
Right.
And that easy money era kind of fueled a lot of growth,
Yeah.
but also came with its own set of risks.
Yeah.
Sound money, on the other hand, suggests a return to a more normalized environment where interest rates are above the rate of inflation.
Okay.
So that means your savings might actually start earning a decent return, but it also means borrowing will become more expensive.
Okay.
So it's a bit of a mixed bag, requiring adjustments to both your saving and spending habits.
Yeah, so no more free money, huh?
Not quite.
Well, speaking of the U.S., the report goes on to portray this surprisingly resilient U.S. economy. Strong growth, falling inflation, a robust job market.
Yeah.
It's almost defying expectations, especially when you consider those restrictive monetary policies.
True.
So what's the secret sauce here?
Well, they pinpoint two key factors driving this resilience:
Okay.
strong productivity growth
Okay.
and a surge in available labor.
Interesting.
So it's not just the Fed's doing,
Uh-huh.
It's a combination of internal strengths. Think of it as a powerful engine that's able to keep running smoothly, even with a few bumps in the road.
Gotcha. But, there are always potential roadblocks, right?
Oh, absolutely.
The report mentions some risks to this kind of rosy picture.
Yeah.
What are they talking about?
Well, they caution that changes in immigration and trade policies could, throw a wrench into things.
Right.
So, for example, tighter immigration policies could shrink the labor pool,
Yeah.
and new tariffs could disrupt supply chains, drive up prices,
Yeah.
and both of those things could fuel inflation,
Right.
force the Fed to rethink its easing strategy,
Right.
potentially even leading to rate hikes.
Yeah, they back this up with a pretty compelling statistic. Between the second quarter of 2022 and the second quarter of 2024, U.S. productivity jumped by 4%,
Wow.
while the labor supply grew by 1.8%.
That's a powerful combination.
It's a pretty potent reminder, I think, that focusing just solely on interest rates and demand
Yeah.
doesn't tell the whole story.
No.
What's happening on the supply side of the economy.
Right.
The factors that influence production and labor are crucial to understanding where the economy might be headed.
Absolutely.
It's a big piece of the puzzle.
It is.
And this reminds me of something else that the report delves into.
Okay.
How unexpected supply side shifts have historically thrown a curveball at, economic predictions and policy decisions.
Right.
They take us back in time to highlight some key examples.
Yeah.
What are we looking at here?
So they contrast the late 1960s,
Okay.
where the Fed's attempt to stimulate the economy through easing basically backfired
Okay.
because it coincided with a productivity slump,
Yeah.
which fueled inflation,
Okay.
with the late 1990s where a soft landing was achieved,
Uh-huh.
thanks in part to a tech-driven productivity boom that helped keep inflation in check.
So in one case, easing fueled inflation.
Right.
In the other, it worked beautifully
Exactly.
because of what was happening on the supply
It's
side.
because of those supply side factors, yeah.
Interesting how history can offer, those valuable lessons for today's policymakers.
Absolutely. And that's why they emphasize the need to monitor those supply-side factors, especially with the potential impact of AI on the horizon.
Ah, yes. The AI factor. Everyone's buzzing about it.
Yeah.
But Vanguard seems to be urging a bit of caution amidst all the hype.
Yeah.
They're essentially saying, hold your horses. This revolution might take a while.
Yeah.
So are they downplaying AI's potential?
No, not at all. I think they acknowledge the transformative potential, but
Right.
they're simply being realistic about the timeline for, widespread adoption
Yeah.
and tangible productivity benefits.
Right.
Any major technological shift takes time to fully integrate into the economy.
Mm-hmm.
Think about the internet. It took years, even decades, for its full impact to be felt.
Yeah. But they do share this rather startling projection in 20 years. AI could be performing tasks that currently account for 30% of working hours
It's a big number.
in developed economies.
It is.
It's a massive shift.
Huge.
So are we all going to be out of jobs?
Well, no, I think their point is that this shift won't necessarily lead to mass unemployment, as some people fear.
Okay.
Instead, they kind of foresee a reallocation of jobs, with workers transitioning to new roles that leverage their, uniquely human skills.
Yeah. So upskilling and adaptability will be key in this kind of evolving job market.
Absolutely.
And the report highlights one country that seems to be leading the charge in AI development.
I wonder who that could be.
Any guesses?
The U.S., maybe?
The U.S., of course, they have a significant advantage
Yeah,
in terms of private investment in AI.
absolutely.
And the report projects that this will translate into, substantial economic growth
Yeah.
driven by AI innovation in the late 2020s and beyond.
They're well positioned.
It seems like it.
Capitalize on that.
So the U.S. seems to be well positioned in this AI-powered future.
Right.
Now let's shift gears a little bit and talk about how all of this plays out in the markets.
Okay.
What does Vanguard see happening in the world of investments in the coming years?
Well, they point to a tension between momentum and valuation,
Okay.
particularly in the U.S.
Uh-huh.
Essentially, assets with strong fundamentals are showing stretched valuations. Think of it like a popular stock that everyone wants to buy.
Yeah.
The price gets bid up even if the underlying company's value hasn't changed that much.
Right. So are we talking about a bubble that's about to burst?
Not necessarily.
Should we be hitting the panic button?
I don't think so. Vanguard's analysis suggests that while valuations are stretched, there are also factors
Okay.
supporting continued growth, at
Okay.
least in the short term.
Uh-huh.
They highlight something called the coupon wall effect
Okay.
in fixed income, which essentially means that higher starting yields on bonds offer a buffer against potential interest rate increases.
Okay, so bonds have some built-in protection,
Yeah,
which is reassuring.
a little bit. Yeah.
But if valuations are stretched in the U.S., does that mean we should be ditching U.S. stocks altogether? What's the play here?
Well, they acknowledge that U.S. equity outperformance in recent years has been driven by robust earnings growth,
Right.
not just inflated valuations.
Right.
However, to maintain that momentum, the U.S. would need to see unprecedented future earnings growth,
Yeah.
which is a tall order.
So maybe tempering those expectations for U.S. stocks is wise.
I think that's a good idea.
Okay. And that's why they emphasize the importance of diversification.
Right.
They point out that emerging markets and European equities offer more attractive valuations right now,
Yeah,
although they come with their own set of risks.
always.
A balanced portfolio, as always, is key.
Right.
Speaking of risks, Vanguard dedicates a significant portion of the report to analyzing how policy decisions, especially in the U.S.,
Yeah,
could throw a wrench in the global economic outlook.
it's a big factor.
What are they concerned about specifically?
Well, they highlight potential shifts in trade and immigration policies
Yeah.
as major factors that could impact U.S. growth,
Right.
inflation, and the Fed's actions.
Okay.
They also express concern about the uncertainty surrounding China's policy response to its slowing economy
Yeah.
and the potential impact of U.S. tariffs on China.
So it sounds like a lot of moving parts on the global stage. Oh, yeah. With the potential for increased volatility in the markets.
Absolutely. Understanding these policy risks is crucial for making, informed investment decisions.
Yeah.
In the coming years, it's not just about picking winning stocks.
Right.
It's about navigating a complex
Yeah.
and interconnected global landscape.
So we've covered a lot of ground here in part one.
We have.
A global easing cycle is on the horizon. But we're entering an era of sound money with potentially higher interest rates than we've grown accustomed to.
Right.
The U.S. economy is surprisingly strong, thanks in part to positive supply-side factors,
Hmm.
but policy shifts loom large on the horizon.
It's true.
And while AI's impact is coming, it's likely to be a gradual evolution, not an overnight revolution.
Yeah, it's not going to happen overnight.
It's going to take some time.
It is, but that's just the beginning of our deep dive.
Right.
In part 2, we'll delve into how these trends might play out across different asset classes.
Okay.
What does this mean for bonds, stocks?
Yeah.
And how can you position your portfolio to navigate this evolving landscape?
Stay tuned.
Stay tuned.
We'll be right back.
We'll be right back. Welcome back to our deep dive into Vanguard's economic outlook. Now let's shift our focus to specific asset classes and see how these global trends could impact your investment portfolio.
Okay, so let's start with, kind of the bedrock of many portfolios, bonds.
Sure.
The report seems to paint a pretty positive picture for fixed income returns over the next decade.
Yeah.
Thanks in part to that sound money era we talked about.
Right.
Higher interest rates should translate into better returns for bondholders.
Right. That's
Right.
the general idea. Yeah. And Vanguard does project, decent returns for bonds over the long term.
Okay.
However, they also highlight some near-term risks that investors should be aware of.
Oh, there are always risks.
Yeah.
So what potential bumps in the road do they see for bonds?
Well, it all comes back to those interest rates.
Okay.
While the coupon wall effect does offer some protection, a sudden and dramatic spike in interest rates
Wow.
could still lead to a drop in bond prices.
Okay.
Remember, bond prices and interest rates have an inverse relationship.
Right.
When rates rise, prices fall.
So even with the sound money backdrop and those higher starting yields, it's not all smooth sailing for bonds.
Not necessarily, no.
Is there a chance investors could actually lose money in bonds in the short term?
There is always a chance, yeah, especially if you have a very short time horizon.
Okay.
The report highlights that risk specifically over the next year,
Okay.
but it's important to remember that bonds are generally considered a less volatile asset class than stocks.
Right.
And they play a crucial role in diversifying a portfolio and mitigating risk.
Okay. So maybe not betting the farm on a quick win in bonds,
Right.
but they still seem like a solid long-term play.
Yeah.
And they even put a number on it, a 75% probability that global bonds will deliver positive total returns over the next year.
That's pretty good.
Those aren't bad odds.
No, not at all.
Okay, so now let's talk stocks. The report dives deep into U.S. equity performance, attributing that impressive run we've seen in recent years to strong earnings growth.
Right.
Not just inflated valuations.
Exactly.
But can the U.S. keep up this momentum? Can we expect that same level of returns going forward?
That's the million-dollar question.
Okay.
Vanguard's analysis suggests that replicating those stellar returns would require either historically high valuations, which, as we discussed, are already somewhat stretched,
Yeah.
or unprecedented earnings growth.
Right.
Both scenarios are possible,
Mm-hmm.
but the odds of the U.S. continuing to dominate in the same way are slim.
So maybe not getting too greedy with U.S. stocks.
Probably a good idea.
But they're not writing them off completely, are they?
Absolutely not. No, the U.S. remains a powerful economic engine
Right.
with many innovative companies.
Yeah.
But their analysis suggests that the potential for outsized returns
Uh-huh.
is greater outside the U.S. right now. They
Yeah.
see more room for growth in regions where valuations are currently more attractive.
That makes sense. It's like bargain hunting on a global scale,
Yeah,
looking for opportunities where the potential reward outweighs the risk.
exactly.
But it's not just about chasing cheap stocks, is it?
No, it's about understanding the unique risks, opportunities presented by different markets.
Okay.
So emerging markets, for example, offer the potential for high growth,
Right.
but they can also be more volatile,
Yeah.
susceptible to political or economic instability.
Yeah, more risky.
Developed markets, on the other hand, might offer more stability,
Sure.
but potentially lower growth prospects.
Right, so it's all about finding that right balance.
It is, yeah, finding the right balance for your individual goals and risk tolerance.
Okay, and they also delve into this whole debate about U.S. equity overvaluation,
Yeah.
which seems to be a hot topic these days. Some experts are ringing alarm bells,
Right.
while others say there's still room to run. So where does Vanguard land on this?
Well, they offer a nuanced perspective. They acknowledge that by traditional metrics, like the cyclically adjusted price-to-earnings ratio,
Right.
also known as CAPE,
KBBs, yeah.
U.S. stocks do look overvalued.
Right.
This metric compares stock prices to their average earnings over the past 10 years, adjusted for inflation.
Right.
And it's often used to gauge whether the market is overpriced.
Okay, so that's the classic,
Yeah.
bubble argument.
Right.
Stocks are too expensive relative to their earnings.
Exactly.
But Vanguard digs deeper.
They do.
pointing to factors like high market concentration,
Yeah.
meaning a few giant companies make up a large portion of the market's value.
Right.
And the fact that many companies locked in low borrowing costs before interest rates started rising.
Right. They got in early.
Yeah.
Yeah.
These factors, they argue, might paint a less severe picture
Yeah.
of overvaluation than the KPE ratio alone suggests.
Exactly.
So maybe not a bubble ready to burst just yet.
Who knows?
But I imagine they don't have a crystal ball either.
Hmm.
So what possible scenarios do they see playing out in the U.S. stock market going forward?
They lay out 3 potential scenarios.
Okay.
First, a continued productivity boom,
Okay.
similar to what we saw in the mid-1990s, driven by the tech boom, could further support those high valuations, especially for large cap and growth stocks.
So maybe those tech giants keep soaring.
It's possible.
Okay, what's the second scenario?
The second scenario involves a shift towards lower interest rates
Okay.
and broader economic growth, which could spark a rotation into undervalued areas of the market,
Okay.
like small cap and value stocks.
So a chance for the underdogs to have their day in the sun.
Ah,
I like that scenario.
yeah, that's a good one.
Okay, and what about the third?
And finally, they acknowledge the possibility that this all ends badly with an unforeseen economic event,
Right.
exposing the vulnerability of those stretched valuations and leading to a market correction.
The uh-oh scenario, the one we all hope to avoid.
Yeah, the one we don't want to see.
But it's good that they're being realistic about the possibility.
It's good to be prepared.
So regardless of which scenario plays out in the short term, their long-term message is clear.
Yeah.
High valuations and stretched profit margins are likely to act as headwinds
Yeah,
for U.S. equity returns over the next decade.
that's what they're saying.
That doesn't mean you should abandon U.S. stocks.
Right.
But it does underscore the importance of tempering expectations
Yeah,
and diversifying your portfolio.
absolutely.
Okay, so U.S. stocks might face some challenges down the road.
Yeah.
What about those international opportunities they mentioned, emerging markets in Europe specifically?
Right.
What makes those regions stand out?
Well, they highlight an interesting dilemma.
Right.
The regions with the most attractive valuations, those that seem like the biggest bargains,
Yeah.
are often the ones most exposed to policy risks.
Interesting.
And many of those risks stem from U.S. trade policies,
Right.
which, as we discussed, are in flux.
So it's a trade-off, potentially higher returns. But with greater uncertainty, that sounds like a tough call.
It is a tough call. Yeah, they delve into emerging market equities specifically, acknowledging that investors hoping for a quick boost to their portfolios
Yeah.
might be disappointed in the near term.
Okay.
They project softer earnings growth for emerging markets, largely due to their less optimistic view on China's economic prospects.
So maybe tempering those expectations for a sudden emerging market miracle.
Yeah, I think that's a good idea.
But what about the long-term potential of these markets?
Over the long term, they see emerging markets as offering reasonable returns,
Okay.
especially compared to developed markets where valuations are higher. Plus, emerging markets offer valuable diversification benefits,
Right.
given their relatively low correlation with other parts of the world.
Right. Their movements don't always mirror those of U.S. or European markets.
Right, exactly.
Which can help smooth out the bumps in your portfolio.
Exactly.
Okay, so a long-term play with a focus on diversification. Got it. Now, what about Europe? They mentioned attractive valuations there as well.
They did.
Does Europe share similar challenges to emerging markets?
Yes. European equities are also vulnerable to those policy risks we discussed earlier, trade tensions with the U.S., or a significant slowdown in global growth
Right.
could weigh on European markets.
So a lot of ifs and buts to consider. It sounds like navigating the global investment landscape is a bit like walking a tightrope,
It is a balancing act.
requiring balance, awareness, and maybe even a safety net.
Yeah, good analogy.
And that brings us to another interesting concept they discuss.
Okay.
Factor investing.
Yeah.
Remember earlier we talked about the potential for a rotation into value and small cap stocks.
I do.
If growth broadens and interest rates fall,
Right?
it sounded like a potential opportunity to capitalize on shifts in market sentiment.
Absolutely.
So what do they say about that?
Well, they go deeper into the historical performance of these factors,
Okay.
highlighting that periods of U.S. equity underperformance have often coincided with strong returns from value and small cap stocks, particularly internationally.
So incorporating those factors into a portfolio could act as a bit of a counterbalance,
Yeah.
potentially softening the blow if U.S. stocks stumble.
Exactly.
Okay.
They also emphasize the importance of considering these factors not just geographically, but also across asset classes.
Right.
So, for example, fixed income also offers opportunities to tilt your portfolio towards specific factors,
Okay.
such as interest rate sensitivity or credit quality.
So it's not just about stocks and bonds. It's about thinking strategically about different investment styles
Right.
and how those styles might perform in different economic environments.
Exactly.
It seems like this report is really encouraging investors to move beyond simply picking individual stocks and bonds
Yeah,
and to think more holistically about portfolio construction.
absolutely. They're providing a framework for understanding not just the broad economic trends,
Right.
but also how those trends might impact different segments of the market. This allows investors to make more informed decisions about where to allocate their capital and how to manage risk.
Now, with all these different asset classes, regions, and factors to consider, what key insights do you think listeners should take away from this part of the report? What are the big picture takeaways for someone trying to make sense of it all?
Well, first and foremost, I think it reinforces the importance of a long-term perspective,
Okay.
especially when faced with short-term uncertainty.
Right.
The market is constantly bombarded with news and events
Yeah.
that can trigger emotional responses and knee-jerk reactions.
Sure. We all feel that.
You do. But as an investor, your goal should be to tune out the noise
Right.
and focus on your long-term goals.
So don't panic and stay the course.
Yeah.
Is still sound advice.
Absolutely. The second key takeaway is the importance of diversification.
Okay.
Spreading your investments across different asset classes, geographic regions, and investment styles
Right.
can help you navigate those inevitable market ups and downs, reducing the impact of any single event on your overall portfolio.
So don't put all your eggs in one basket. A classic piece of wisdom that still holds true.
It really does.
What else?
The third takeaway is the importance of understanding those policy risks we discussed earlier.
Right.
They have the potential to significantly impact market performance,
Okay.
both domestically and globally.
Yeah.
Staying informed about these developments, trade policies,
Right.
immigration policies, geopolitical events is critical.
So stay informed and be adaptable.
Exactly.
Okay, got it. Anything else?
Finally, I think it's worth emphasizing that while this report provides valuable insights and projections,
Sure.
it's essential to remember that these are just forecasts.
Right.
No one can predict the future with certainty.
No crystal ball, unfortunately.
No, unfortunately not. The future is inherently uncertain.
Uh-huh.
And unforeseen events can always disrupt even the most well-crafted investment strategies.
Right.
That's why diversification, a long-term perspective, and staying informed are so crucial.
Okay, so stay humble and be prepared for the unexpected. That's good advice for life in general, wouldn't you say?
I think so.
But now I'm curious, where do we go from here? We've talked about all these different moving parts,
Yeah.
but how do we actually put it all together?
That's a great question, and that's exactly what we'll explore in part 3.
Sure.
We'll delve into Vanguard's specific 10-year projections for various asset classes
Okay.
and discuss what those projections mean for you as you build and manage your portfolio.
All right, so we're back for the final part of our look at Vanguard's economic and market outlook.
It's been quite a journey.
It has. In this last part, we're going to get into the nitty-gritty.
Okay.
Their 10-year projections for different asset classes.
All right, let's do it.
Now is where we can really start to visualize how this all might translate, into your own portfolio.
Right. Get down to brass tacks.
Yeah, exactly.
Yeah.
So it's important to note that Vanguard isn't just like throwing out numbers here.
Right.
They're placing these projections within the broader context we've been discussing.
Yeah.
The global easing cycle, the sound money era, the potential impact of policy shifts, and the evolving role of technology.
It's all connected.
So it's more than just a numbers game.
It is.
There's a whole narrative kind of woven into these projections.
It's about understanding the forces that are likely to shape returns over the next decade and using that knowledge to make informed investment decisions.
Right. It's like having a roadmap, not just a destination.
Exactly.
Okay, I like that analogy. So let's get into the details of this roadmap.
Okay.
Where do they see things heading for investors over the next 10 years?
Well, they start with a classic benchmark,
Okay.
a 60-40 portfolio,
Yeah.
that traditional mix of 60% global equities and 40% global bonds.
Right, the old standard.
The classic.
Yeah.
And they project this portfolio to return between 2.5% and 4.5% annually over the next decade.
Okay, so a moderate but potentially steady return for a balanced portfolio.
Yeah, pretty reasonable.
Okay, but what about those individual building blocks?
Okay.
Where do they see bonds heading over the next 10 years?
So for global bonds, they're forecasting annualized returns between 2.1% and 4.1% for euro investors.
Okay.
This is driven by their expectation that interest rates will remain relatively stable and that the global economy will avoid a major downturn.
So bonds could offer a nice source of, stability and income at a portfolio, even in this sound money environment.
They could.
But I remember you mentioned earlier that U.S. stocks have been the star performers over the past decade.
Yeah, they've had a good run.
Are they predicting that trend to continue?
Well, that's where things get interesting.
Okay.
While they acknowledge the strong performance of U.S. equities in recent years, they actually see that trend reversing somewhat in the decade ahead.
So are they saying we should ditch U.S. stocks and move everything overseas?
No, I wouldn't say that.
Okay.
It's not about making drastic moves. It's about recognizing that the potential for outsized returns might be greater in other parts of the world right now. For U.S. equities, they project annualized returns between 0.7% and 2.7% over the next 10 years for euro investors.
Okay.
That's significantly lower than their projections for global U.S. equities,
Okay.
which they see returning between 2.1% and 4.1% annually.
Wow. That is a significant difference.
This is a big difference.
What's driving that disparity? Is it all about those stretched valuations we talked about?
Valuations definitely play a role.
Yeah.
As we discussed, U.S. stock valuations are relatively high right now, which could limit future returns.
Right.
Meanwhile, international markets, particularly those in emerging markets,
Okay.
offer more attractive valuations and greater potential for growth.
So it's not just about fleeing the U.S.
No.
It's about exploring opportunities where the potential reward might outweigh the risk.
Exactly.
They also provide some pretty intriguing projections for specific regions and investment styles.
They do.
I'm particularly interested in what they have to say about Europe and emerging markets.
Okay, so for euro area equities, they're quite bullish, projecting annualized returns between 5.1% and 7.1% over the next decade for euro investors.
Okay.
And for emerging market equities, they forecast returns between 3.1% and 5.1% per year.
Those are some pretty compelling numbers.
They are.
Does this mean we should be loading up on European and emerging market stocks?
Well, hold on a second. Remember, those higher potential returns often come with higher risks.
Right.
It's crucial to remember that these are just projections based on certain assumptions about economic growth, inflation, interest rates.
Sure.
Geopolitical stability, things could easily change,
Right.
and those projected returns could shift.
Okay, so temper those expectations, even for regions that look promising on paper.
I think that's wise.
But it does seem like they're advocating for a multifaceted approach to investing, considering different regions,
Absolutely.
different asset classes, and even those factor opportunities we discussed.
Diversification is key.
Yeah, absolutely. So they highlight that value and small cap stocks have historically performed well during periods when U.S. large cap stocks have struggled.
Right.
So incorporating those factors into a portfolio could help smooth out the ride
Yeah.
and potentially enhance returns over time.
Exactly. It's about building a portfolio that can weather different market storms,
Right.
not just chasing the hottest trend of the moment. And remember, diversification isn't just about geographic regions or asset classes. It also extends to investment styles and factors.
So we've explored the numbers, we've looked at the projections, but now I'm curious, what does it all mean?
Okay.
What are the key takeaways, for listeners as they think about their own portfolios and their own financial futures?
Well, first and foremost, I think this deep dive highlights the importance of a long-term perspective.
Right.
Don't get too caught up in the day-to-day fluctuations of the market or try to time the market. Perfectly focus on building a solid, diversified portfolio that aligns with your long-term goals.
So patience and discipline are key virtues for any investor.
Absolutely. The second key takeaway is diversification is your friend.
Diversification.
It's the closest thing you have to a free lunch in investing.
Okay.
Spreading your investments across different asset classes, geographic regions, and investment styles can help you mitigate risk and potentially enhance returns over time.
Don't put all your eggs in one basket.
It's a classic for a reason.
What else should listeners keep in mind as they kind of navigate this complex world of investing?
Well, third, stay informed and adaptable. The world is constantly changing, and so are the forces that shape investment returns. Keep an eye on those policy developments, technological advancements, and global economic trends that we've been discussing.
So stay curious, stay engaged.
Yeah.
Don't be afraid to ask questions.
Absolutely.
Anything else?
Finally, I think it's crucial to work with a trusted financial advisor
Okay.
who understands your individual needs and goals. Investing can be complex. Especially in a world that feels increasingly uncertain, a good advisor can help you make sense of it all, navigate those complexities, and make informed decisions that align with your long-term vision.
Excellent advice. Finding a trusted guide can make all the difference in navigating this journey.
It can.
Well, we've reached the end of our deep dive into Vanguard's economic and market outlook. It's been a fascinating exploration of the trends and forces shaping the investment landscape.
It really has. And remember, these insights are meant to empower you, not overwhelm.
Right.
You use them as a starting point for your own research and conversations with your financial advisor.
Yeah.
The goal isn't to predict the future perfectly. It's to make informed decisions that position you for long-term success, whatever the future may hold.
Beautifully said. And to our listeners, thank you for joining us on this deep dive. We hope you've gained some valuable insights and feel better equipped to navigate the exciting and sometimes daunting world of investing. Until next time, keep learning, keep exploring, and keep investing in your future.
We'll see you next time.